Hi, everyone. Welcome to the TimingResearch.com Analyze Your Trade, episode number 182 for December 28th, 2021. We are recording this at 4 p.m. Eastern Time, and this will be the last Timing Research show for the year. So my name is David Kosmeter. I'm the creator of TimingResearch.com, and today we'll be discussing your trade ideas. And I have arranged for the option professor to be here for a solo market outlook and options income and trade analysis episode. So I'm going to go ahead and turn it over to him.
Sure. Thanks, David, and welcome everybody. Good to have you with us here. Had another exciting day in the markets on a couple of things, and the indexes were kind of not doing too much, but we had a very big day yesterday and of course last week. So plenty of money being made on the upside with some of these markets. Just as way of introduction, I'm option professor of optionprofessor.com. I've been doing this for decades. Graduate of Boston College, and again, I've been in the option business for a long time. Have done hundreds and hundreds of seminars for thousands of people across the country. So I explain the uses and risks of options. I'll cover what the markets are doing, and I'll give you a few different option ideas. But let's start out with making sure everybody's clear that today I'll be sharing with you my opinions and my observations. But all investing involves risk, so you should always consult with your brokerage firm and your broker. That's the guys who determine your risk tolerance as well as your suitability to do any trading. So again, what I'll be showing you today is my opinions and my views, and it will not be advice. It's just information. Okay, so let's get going and see what's going on. We start out with the broad markets on the S&P 500, and basically today it looks like it's pretty much flat. I'm going to show you things on different time frames. So you put things in a longer term perspective, an intermediate term, and a shorter term perspective. Okay. So I'm just going to go over the general indexes right now. We're going to start out with the S&P 500. You can see it's in a huge uptrend and has been so ever since the crash in March. So if you used a simple moving average like this red one, you'd be in there ever since the beginning, never sold anything, and you would be very, very happy today. I like using moving averages because again, they're based on price and time, not people's opinions, not people's talk or any other nonsense. Again, I've been doing this a very long time, so I try to look for things that are based on facts more than just guessing. So again, price and time is very good on a 20-year graph, but it is extended. I mean, look how far you are from the long-term graph, and this goes back 20 years. So show me another time when it was that much. You want to know why it's up this much? Very simply, the money supply is up 35% from where it was pre-COVID. When you pump 35% into the money supply on a nation as big as ours, what do you think are going to happen to assets, particularly when you pump in the money and you keep money market at zero? Obviously, it's going to be a fantastic time for risk assets, and it certainly has been. So again, the explanation of this to there comes in from what? Huge money supply growth, providing liquidity, companies having operating leverage, which means they got rid of a lot of expenses during the crash and they didn't bring them all back in. And now their earnings are up big against much lower costs. There you go. Okay, so that's why you're here. Now let's look at the 5-year graph. And you'll see on a 5-year graph, again, been a nice steady uptrend. You follow the blue line up, you would have never sold. And then basically it's at the all-time high here now. I'm going to throw the RSI up there because from time to time I like to refer to that. So I'm going to put that up now, and you guys can see what the relative strength of the market is. I like to use 28. It's a little less bumpy than the 14. So we'll turn 14 into 28, and we will have a 28 RSI. Okay. And again, I like to use RSI basically in couple of different ways. One is I like it to use it as a barometer on how the market's doing. So you'll notice that when the market's up trending, we're above 50 pretty much the whole time. If the RSI gets above 60, that's when I'm expecting an acceleration. So if we're under 50, that's a negative, barometer. And basically, if you break 40, you accelerate to the downside, just like when you break 60, you accelerate to the upside. That's how I use it. That's my opinion. That's my observation. Okay, so anyway, on this one, you're still extended. The moving average here, even on the 5-year, comes in at 4,400. And you can see we tested the 24 SMA and it held. So that's when I was telling people 4,500 on the S&P is the level. You don't want to sell against that. You want to buy against that. And certainly that was very good input that I gave people at that time. With regards to the 1-year, you are looking at moving averages all coming in. Yeah, I like 4650 as the line in the sand. You get underneath 4650, something's changing. So 40, if we pull back, I'd like to see 4700, 4650 hold on a pullback. Okay. And then the RSI right now is in the level of 58. So again, it's right up against 60. 60 is where it can turn down from. Some people think 4,800, today's high, 48.7 is the short-term peak. That's possible. We'll have to see. Turnaround Tuesday held up pretty well, though, considering the advance we had. The pullback today was really a joke. So turnaround Tuesday held up pretty well. Let's see what else is going on here. So that's your S&P. You got some good lines in the sand to discuss right there. Let me give you NASDAQ, which we'll use QQQ as, okay? And on the Qs, we will see on a 20-year basis that we are very, very extended. So, again, money market is very low. So TINA, there is no alternative, is a big thing. Valuations are quite high on a lot of these stuff. Some of the big stocks, the big 5, represent such a big portion of that. So they could look good while the other 80% of the stocks go in the tank, which has happened. So you got to be careful about, this sector, but the thing's very, very much, obviously, it got you long here and you never would have got out. So you could have made a lot of money just following a simple moving average. All right. On the 5-year, we are again, we are making a lot of new highs here without a big confirmation on the RSI. So again, pulled back to the 24 SMA that I talked about, which on that was around 360, around 380 ballpark. And again, right now, you'd certainly want it to stay above 367. Looks good though, but it is a bit extended. On the 1-year, again, hasn't taken out that high. You got a lot of support in here, 392, 394. So we break under 390. That certainly wouldn't be any good. Nice little line in the sand here. New high up here, but RSI is not making a new high. So, you got to be a little bit careful when you get that kind of situation. And the whole world is telling us what? We're going to rally into the end of the year. January is going to be an up month. Well, that's pretty popular. And so sometimes popular doesn't work out so well. So again, there's different tactics you could consider. If you thought this thing was going to fail, you could see what the calls are going for up here at 410 and what the puts are going for at 390. If you want to collar your equity, you sell the call up at 410, you buy the put at 390, and now you have at least collared it until you see which way it breaks. If it goes up and you have to buy back your call, so be it. You'll already have made more money anyway. And then if you want to roll it up, you buy back the 410, you sell the 440, and then you increase your ceiling. And then basically you have the upside potential higher from 410 to 440 if that's the way you played it. Again, though, if you want to protect your equity, which is what people would do if they thought this thing might not go through, then bottom line is you could look at a collar, which is the selling of the call in this example, 410 buying the 390, and that gives you upside potential to 390, and it's got you insurance at at 410 and insurance at 390. Okay. All right, so those are the indexes. Now let's get into your stocks and let's get going. There are some stocks that had some pretty unusual activity today, like Disney and Macy's. I hope we have time to talk about those. And then I'll also give you a few other ideas that I'm seeing as well. So let's start out with Apple. And we'll take a look at the stock. And Apple's got a P ratio of about 32 right now. I said Apple, not Advanced Auto Parks, AAPL. Okay. Now, Apple, again, we're going to look at it on all three bases. We're going to start out with the longer term chart, and then we're going to go to a shorter one. On a long-term basis, you can see Apple, obviously very, very extended, like all stocks are. Again, what people are concerned about in the first half of the year is as simple as this. The GDP is huge right now, right? And earnings had a very huge jump this year. Okay. And we also have had a very expanding PE ratio. Okay. Now, next year, we got the Fed stop the tapering, very much a lot of heat on inflation. So the likelihood that they may have to do some tightening, and that tightening is going to be done in the front end of the yield curve. So that's why people are in shock that the 10-year and the 20-year yields are not rising. The 10 and 20-year yields are saying they're going to win and inflation is going to come down. And if inflation comes down, you don't have to bid up the longer term duration. But what is in jeopardy is the 2-year note. And the 2-year note has been rising substantially because that's the neighborhood that the Fed would do their tightening, and it would affect that tightening in the 2-year note. If the 2-year yield gets above the 10-year yield, that's called an inverted yield curve, and that leads generally to recession. So keep an eye on that. But at any rate, this is a stock that obviously is bulletproof. Everybody goes in here and they just think they're buying money market. And so far, it looks like they are. But that's a long way away from its moving averages. And so that's why the market would be possibly vulnerable if we're going into a less accommodative stage. And that doesn't mean the market collapses and stays down. It just says that you could get a nice big correction because there's a lot of real estate between 190 and 140. Let's look at the 5-year graph. Again, you're up here in the 180 area. It's on its all-time high pretty much. If it goes to 182, I heard it's a $3 trillion company. I think only 3 or 4 years ago, it was a 1 trillion. So that's pretty big acceleration. And again, it is extended off its moving averages, and the RSI is in the area of 68. So remember what we said when RSI gets above 60, which was probably when? Let's see. Well, it was here. Let's see where RSI is at 58 here. We said if it gets above 60, you go into an acceleration phase. Well, it got above 60 at 142. And I would say a $40 move on a 140 stock is an acceleration phase. There's my case in point on why I like it above 60 when it's going to accelerate. Okay, so what would I possibly be thinking about up here? Let's look at the 1 year. And here you've got a potential double top, but you also got a market that's very strong. RSI right now is up at 64. Okay. Now, I've also found that when the RSI is up in the 60s and it breaks under 58, that's another number that has worked out that is the beginning of a more significant drop. So this thing staying above 175 here, and the RSI staying above 57, 58, I think is very key. I would use those two numbers as a little bit of a guidepost. Again, if you think it's a strong market, some people would sell puts underneath the 160 mark and the 165 mark and say, listen, if you put stock to me, great, or I'll collect the premiums. So that's great. Selling a put means you're agreeing to buy the stock at the strike price, 100 shares on every option. Okay. And obviously selling puts all the way up underneath this green line has worked out pretty good if you want to keep the premium. And if you sold the puts underneath the red line all the way up, you would have got put some stock here. Or you buy back the put and roll it down. Okay. So bottom line is, if you wanted to protect your equity up here, you thought for whatever reason it's not going to run through, you take a look at your 185 call, see what the premium is, take a look at your 170 put, and at least then you have parameters around your equity. But this thing does look like it's trying to take out the high. Okay. The question is after the first of the year, will everyone be buying as everyone expects, or will that cause a little bit of selling because then people can defer the tax for another year? People may be hesitant to sell going into the end of the year because they'd create a tax bill. Of course, a lot of people created that tax bill when we dropped down from 180 down to 168, because I'm sure there were some people panicked out. Now they got a tax bill. Okay. All right. So Apple, again, good looking company. Obviously, lots of ways they make money. And frankly, like I say, it's where people hide out. It's part of FANG. Again, next year, people are thinking that Apple will actually expand their PE ratio, or it'll remain steady and their earnings will spike, which will allow for higher valuation. But your Facebooks, your Apple, your Amazon, your Google, your Netflix, your Nvidias, that's where people are thinking they're going to hide out with some of their money if the first half of the year is going to be rocky. Okay, next one up is going to be Tesla. Now, this is the one where some people are saying the news is changing. We'll have to see. This one has a high valuation, 354 PE ratio, but it's at a high valuation ever since it started. It's not about valuation, apparently. It's about a belief that this is going to be the future for sure, and these guys are going to be the leaders of it for sure. And that's a lot of for sure. So the bottom line is it peaked at 1,250. It came all the way down to 900. Now it's come back up above the blue line. So if it gets back underneath the blue line here, well, let's talk about the 20-year graph. It doesn't probably have one. Yeah. Again, 800 would be a line that if it did pull back, that would be an interesting number for it to hold. And then if you're looking at the, what's the RSI on this thing? RSI is up at 76. So, you know, very high. Here you go. We pulled back to the green line. So again, if you were bullish on Tesla, you wanted to buy it against the 24 SMA. That was a perfect time to buy. That's why I follow these moving averages, because I don't like guessing. So bottom line is that's where you should have been buying or selling puts. How about sell the 800 puts? They either get it to you for 800 or you keep the premium. Or you sell the 800 put, take the premium, and buy the 1,000 call. And then if it pops through 1,000, which it has, you've got a free look at the call if the 800 put could pay for it. And again, you were on line to buy the stock at 800, but you didn't miss out on the total upside because you took the premium and you bought the call at 1,000. On the 1-year graph, let's see what the RSI is here. Yeah, again, 60. So it's at a key zone right here. Some people are saying that some of the consumer input on the car is complaining about mechanical situations. I read that somewhere. I can't confirm it's true or not, but if it's true, that wouldn't be the kind of stuff you wanted to hear about your car company. Right now, again, on the 1 year, you got the moving averages coming in at 1,050. You'd like to see that. This curling up is a good sign, but that curling up is down at 1,050. Excuse me, 1,000. It's at 989. It's about $1,000. So there's a little bit of a 10% move down that it could still have and still be good. The RSI right now on the short term is at 55. So again, if it can't get through the 60, and then it can't go to the higher levels, because that's what it does when it goes to higher levels. So I would say that if this RSI gets through 60 and you start breaking above these highs here, that would open the door to all these higher prices. Okay. Now, again, this is a very volatile stock. I'm sure the options are very expensive. It's an expensive stock. So when you sell a put, you got to realize that you are contracting to buy the stock. If you don't have the money or the interest to do it, or can't take the risk, don't sell the put. But if you can, this is a strategy that might make some sense, because these premiums are enormous. So if you own the stock, sometimes just a covered call makes sense, where you buy the stock and sell the call. Sometimes these calls at 1,150 or 1,200 could go for a heck of a lot of money, which means you still have upside from where the stock is up to the strike and plus the premium. So that's not so bad. And that premium minus where you bought gives you some downside buffer. So covered call writing would be something to consider here as well. And of course, if it's a rising market, the put selling is also a good strategy as well. But again, you have to be willing to do what the contract is telling you you're obligated to do, which is buy stock at the strike minus the premium received. Okay, let's see. So Tesla, again, obviously it's looking good, but I don't really like this blue line sticking down. So if it starts getting back under 1050 and then 1,000, then of course I would be concerned. So, see how that goes, because this could be a reverse situation where it goes up here, fails to take out the highs, and then if it comes back down, this could be a setup for a more significant drop. So be careful of this number 1050. going underneath there and going underneath 1,000 would be very, very much not good. Okay, turning to Ford. Ford has a PE ratio of about 50. The reason I'm mentioning PE ratios, next year it's going to be important, I think, meaning people are going to actually say, I'm buying this stock. What the heck is the earnings on it? And what's the earnings in relation to the price? Because this year they whacked a lot of companies that had crazy PE ratios like Zoom and DocuSign and Peloton and all the rest. So, next year, people are going to sharpen their pencils, I think, and they're going to be looking more towards what these things are really worth as opposed to just names that are momentum. Okay, so here's Ford. Let's look at it on a 20-year basis. Very extended, obviously, on a 20-year basis, but these guys are coming around. They got the electric thing going. They got that F-150. They are definitely out there competing. Their PE ratio on Ford is 30. And the 5-year, again, held the red line again. So that was a good place to buy against, about 19 bucks. You don't want it underneath 19 bucks, I don't think. RSI is up 68. That sounds like a high number to me. But again, that's when you accelerate. Let's give you another example. The RSI on Ford was right here, coming in at 57. Okay. Once it broke above 60, you went from 14 to 22. You get the idea why I watch RSI? It's not a bad thing to do. Okay. So there you go. You want this thing, obviously it's extended. So if you want to keep it on a relatively short leash, 19 is your number. If you want to keep it on a really short leash, then I think these numbers here make sense, which is 19.90, about 20 bucks. You really want it to stay above 20 bucks. And so let's see if that'll happen. And the RSI is right at 60. So if this thing starts trading 55 or 54 in RSI, you're probably going to be looking at sub 19. Again, if you like this company, you could sell puts on it. I don't know how big the premiums are. You got to price them out. You got to be willing to take the price of the option, take it away from your put. And if that's the price they're going to put stock to you, net to you, then obviously if you're happy with that and you can afford it and you can take that risk, then it makes some sense. Again, this company has been in a little trading range of 19 and 21 now. Since when? Went into this range in November. So November, December. For the last 2 months, it's been range bound. Looks like it's got an upward bias, no doubt, but again, you know where the lines in the sand are. Again, and again, as long as the blue line is rising, you'll notice that even if it gets penetrated, as long as it gets right back above it, you're okay. It's when it breaks underneath it, like over here back in July of 2021, where it can stay under there, and then you could find yourself losing money for a while. Okay. All right. So Ford, like I say, looks pretty good, but that's the way I would see it. That's the way I would consider it. All right. Here's the one that's had news, SSNC. This thing had news, and let me show you what the news was. This is a technology company. Basically, they are located in Windsor, Connecticut, headquartered, and they just struck a deal with, they made a strategic investment with a couple of companies, Equiniti and AST. AST is a leading provider of US shareholder technology, and the other company is a leading US and UK provider of shareholder pension remediation credit technology. So it's a very strategic arrangement, and that's why these guys have caught a bid. And this just happened somewhat recently. All right, having said that, let's take a look at the technicals and see what it looks like. Sounds like they got a good partnership or investment going. Okay, so here we're extended on the 20-year. It's going up to, it hit the red line, hadn't taken out the green. So there's your moving averages on that. RSI is up at 61. So it might be getting ready to take a nice shot to the upside. The 5-year, again, it came down and tested everything around 75. That was the time to buy on the dip to 75. And now it's extended again. Again, the RSI here on the 5-year is at 60 area. So if it can start getting much above 60, we could start getting an acceleration on this. Again, with that news, I wouldn't say it's off the charts. Looking at the 1-year, again, very extended short term on the news. Maybe it pulls back towards the 80 level, and that would be a nice place to maybe take a shot. and the RSI on it right now is coming in at 63. So again, if it got to 57 on the RSI, you're probably down into the support zone. Again, this kind of a company, it has great news on it. You want to sell puts, you might want to sell it in the 79.80 area. And then if you get put stock, so be it. Or if you wanted to collar your position a little bit, this thing's been hot. So go check out what the 85 and 86 calls are going for. And because again, if you look back to its whole history, it is on the all-time high, but it's just struck a very interesting, because they have technology that these people want, and they seem like they've got a pretty good connection there. So, but if you thought it might peter out at some point, you can sell the out of the money call, pick a strike price you can live with, and then take that money and buy a put and collar your equity. And then at least if the market tanks on it back to whatever, you could protect what you've earned, protect what you've made. To whatever the degree the collar does. Okay, so yeah, that company had news, so that was obviously somebody's excited about that, and they should be. Right now, if you want to keep it on the shortest leash that I would look at, it'd be the 1 month, and there would be this red line here, and the red line comes in at 82. So keeping it above 82 would be a very short leash. I can see in the aftermarket is trading 83. So yeah, if you want to keep it on a very short leash, 82 seems like a reasonable number to keep it at. Okay, let's turn over to the next stock, which is something that I definitely am a proponent of, and that is medical devices. I think this one looks great. Think about it. If we're going to normalize ourselves next year, we're going to get through this COVID season. They're going to get through it. And then we're going to hopefully find that it's not as serious. And we've got these pills you can take if you get sick, and that we're going to normalize ourselves going into spring and summer and fall next year. Then obviously people who needed the knees done, the shoulders done, the elbows done, the hips done, and everything else, and all the other kind of devices, I think, these people are going to get going. And so that's why I think this is a fantastic buy down here. But only time will tell. But let me show you what it looks like. On the upper graph here, it's never broken the red line. So basically, where's that come in? Risk it down to about $60. RSI is extended on the long term at 70. But, obviously, it's very powerful upside. This is part of the healthcare sector that people are talking about. Now, this thing looks like it's trying to take off. So where's your blue line? It comes in at 62. There's your green and red coming in around 64 and change. So there's not too much risk between there and where we are here. So if it can stay above here, fine. It's right at 60. So if it's going to accelerate, this could be the neighborhood where it could happen out of. On a 1-year graph, it's popping. And again, you'd like it to stay above 62, 64, 63, 64. Not tremendously far from where we are. And where's your RSI? Your RSI right now on here is 55. So if we can get above that 60, maybe we can get an acceleration on this thing. Again, this is an area that has, again, been waiting for everyone to go back and get those elective surgeries and those type of things. So I think this looks pretty good in my opinion. Selling puts at 60, anything you can collect 62, depending on what the premiums are. You don't want to be selling options for no premium. I know that's a very popular thing to do. My opinion is that's a joke. If you're going to sell options, get some premium, because if you're selling a call, you're giving up all rights on your stock. If you're giving up all rights on your stock for no premium, that sounds stupid to me. If you're going to sell a put, you're agreeing to buy a stock. Lord knows where all these stocks end up going. So you're going to be taking a risk by agreeing to buy the stock. So to go out there and sell tiny premiums, in my opinion, is silly. So bottom line is, if you're going to do any option strategy, try to take some premium in that makes some sense. And that would be my suggestion to you. Okay, this again, very much positive on, as long as we stay above 60 for sure, and better yet would be 62 and 64. Okay, and it looks like it's trying to break out, only time will tell. The good news for me on this is the difference between where I was involved in it and where you could get involved in it and those moving averages is pretty small. Okay, next one is TEX. This is another one that I did a little homework on. They're located in Westport, Connecticut. They are a manufacturing of lifting materials and handling plant. They're involved in construction and mining and energy and infrastructure and quarrying. I guess that has to do with stones, energy and shipping. So these guys sound like they're into the industrial section. And again, that's why it's still playing a little game of catch up. So let's see and what it looks like and go from there. Okay, on the long-term graph, it looks good as long as you can stay above about 32, 33 bucks. So, and on a very short leash, you'd like it to get above 45 and change. So if we get above 45 and change, looks very good. And if it has a sharp pullback, it could go and hold into this area. RSI is around 55. So you know what that tells me? That tells me if it starts getting above 45, 46, and the RSI breaks above 60, it's probably going to go. All right, looking at number 5, 5-year graph. Here you have got a situation where you'd like it to get above, well, the RSI is at 51, which is great because that's where it starts. As long as we're above 50, that starts the bull story. If we go to 55, it's getting more bullish. If it goes to 60 or better, it's on a run. So bottom line here is it's starting. And so basically you'd like this to start getting above these moving averages. And where are these moving averages at? They are at 45. So let's get above 45. That's door number 1. Door number 2 comes in at 46 and then 47. So you got the 3 horsemen there, 45, 46, 47. And then maybe we can get going with the RSI climbing. It could be something there. Okay. So keep an eye on this one. It looks interesting, but it looks like double bottom at 40, right? So it looks good. The RSI is starting to climb, but it's still in Missouri, the show me state. It's got to give me some more positive numbers. On the 1-year graph, let's check it out. Same idea. You're above these averages, which is nice. Your RSI is doing what? Your RSI on the 1 year is at 48. See, need a little bit more before you get on this train, I think, because once you get on it, if it gets above 46, 48 and something's happening, it's going to have a 50 print. But what if it holds this blue line and start tanking? You don't want that. So bottom line is I would probably wait for this to show me a little bit more. Again, sometimes people don't understand. Buying something at 47, if it's on its way to 54, is better than buying it at 44 and finding out it's never going to 47 and end up going down to 40. Momentum is not a bad thing when you're investing. You want to have something going. Okay, that's pretty much the story there. PE ratio is only 17, so that ain't heavy. So it has some things going for it. The RSI is getting above 50, needs more. Stocks are up above some of the averages, but need to clear 45, 46, and 47, still to come. And then again, the PE ratio of 17, if next year is the year of the more moderate PE, this would be something for next year. Okay, AMAT, they just made, I think, all-time highs today. So who's ever in this, hopefully you've been long for a while because all-time high sounds like a good deal, although it did roll over again at the end. Let's take a look. Again, you know, you had your opportunity when it comes down to the red lines. That's why I like using these averages. Okay, you buy against them. So right here, you could have been buying here at the low 123, right? And then within a day or two, boom, you're back up. So there you go. It's extended and the RSI is at 77. So, you know, this is an extended market. You know, if you want to look at the 170 calls and see how fat they are and buy the 150 puts and collar it for a while, you know, that's a way that you call the dogs off. Meaning what? You have parameters around your equity where you can still make up to 170 and you can get insurance at 150. Providing the options offset each other. If they don't, then you got to adjust the break evens accordingly. But bottom line is selling the put under the blue line all the time has been a good deal. Maybe you would have got put some stock here, maybe not. And then basically it's been pretty much all the way up. On a 1-year graph, again, you want this thing above 150. You don't want this thing under 150. And then the RSI is at 57. So you're at a critical point for it. Because if it can go through 60, maybe it's going to break out above 165 and go nuts. Maybe there'll be a January stampede that everybody keeps telling me about. Or maybe it's not going to come in as a stampede. This thing never gets above 60 on the RSI. It blows out 150 and now it's down here and everyone's got egg on their face. Okay. Sometimes what people do when stocks are up like this, let's say you bought the thing at 125, give you another option idea. You go up here at 125 and it goes all the way up to 160, right? Well, actually, what was the high today? 160, 163. So it goes up to 163 and you go, you know what? This thing has gone on a big run. I think these calls up at 165 are going for 15, let's say. I don't know what they're going for, but they're probably going pretty fat if it's going up like this. So you check out the call and you go, that's pretty high. So I think I'd like to hedge myself. I'm going to sell those calls and I'm going to take that and buy the puts at 155. And then until the option expires, you've got parameters of 165 and 155 on this stock. So if it does go way down, then at least you have some insurance on it. If in fact it keeps going, yeah, you'd have to buy back the call at a loss. You could make up that loss possibly by selling the higher call and bringing more premium in. Or if you really think it's going crazy on the upside, you buy back the call at a loss, but the other stuff is going up for you. And if it's got another 15 bucks on the upside, what do you care if you lose a few bucks on the call? Okay. So again, with these option strategies, you got to know what you're signing up for. You got to know the risk reward. You got to know the opportunity risk you might be handing off, the real risk you're taking on. So there's a lot of questions to be answered, but I'm giving you some broad strokes on some of the things that I would be looking at and considering if in fact I was in these stocks. Again, if you sell puts down underneath 150 and these moving averages hold, you'll be in good shape. The best time to sell calls, for premium is when stocks are rising, because that's when people are buying them, right? And when markets correct, like they go from 160 down to 140, that's the time to look at your puts at 140 and 135, because that's when people are buying puts. So again, it's like any merchandising operation. It's you get a much better price when you sell things when people are buying them, like real estate now. You get a much bigger premium on a put option when everyone is selling things. So bottom line is, remember that when you're doing your option trading as well. Okay, that's AMAT. Looks very good. Obviously, you can't really complain on anything that's an all-time high. The only question is it going to have a pullback? And if it does, those are some lines in the sand to keep an eye on. 150, I think, is a pretty big number. On the 5-year graph, you've got 140 area is a big area, and then 145 about. So there's support all the way down if it does start dipping. If this RSI starts getting above 60, though, well, it is 60 now. If it keeps going above 60, you've got a good shot that it might take off. If it starts going under 57, 56, then a correction more than likely is in hand. All right, next one up is SKX, another one that I looked up, and that's Skechers. And here the question is, I think the question is, and it's going to come up again, is the apparel boom over? Inflation is really big, right? But you know what inflation's big in used cars. Now, come on, is used cars going through the roof a weird deal? Of course it is. Do weird deals last? Of course they don't. Apparel jumping through the roof. I mean, apparel is one of the most discounted things out there generally, okay? But not when there's bottlenecks and not where there's shortages. But shortages don't last forever. And demand, after you bought 19 shirts, you're not going to buy 19 more. So the bottom line is the question with Skechers is the apparel demand and pricing power behind us? And I would say that there's a decent shot that it is. So if that's in fact true, this is a rough one. It might have a rebound rally. Okay. But it also may have a hard time getting through 48. And if it does, then obviously this rebound rally is to be sold. Let's look at it on a 20-year basis. Again, when you get way away from the averages, they do come back. This is called reversion to the mean. So go look at all those charts that I was showing you on those longer term charts when we're so far away from those moving averages, and say to yourself, is 2022 the year where we have reversion to the mean? And if I've got a ton of money at risk in the stock market, what am I going to do to prepare for what could be, as some call, a rocky year? And again, you see, when things go way away from the averages, they do come back. They do come back. So anyway, how do I feel about stretchers in our opinion? It's in an uptrend, and it's actually went down towards a buy zone here when it went into the 36 to 38 area. Okay. And the RSI went down to what? The RSI here went down to 54. So it worked off a lot of overbought down here. So if you were going to take a shot, you take a shot here and you get out underneath 36. Down here, though, on the 5-year, it still looks like it's oversold, right? Oversold. So what do I say? Reversion to the mean, which is up in this neighborhood. If it can get above this neighborhood, yeah, I'd change my tune. In fact, I'd start looking at changing my tune if it can get above 45.22, because that's the first level and it's starting to flatten out. And the RSI is right at 49. So right now, is this the thing that I'd be interested in? I'd be interested in it. I'd be very interested if it starts getting above 45.22 and the RSI broke above 50. On the daily graph, 46, you're still underwater on the RSI. You're above the first level, 42.52, but they're all inverted to the downside. Okay, but that's why I say it could have a rally towards 46.48, jump above these averages temporarily, but again, right now it looks like it hit a spike low. It could be turning, but this thing could also come down and do a little testing down here too. Because like I say, when people made big money on it, where was the blue line going? Now, since the blue line's been coming down, people haven't been doing so well. Yeah, it went up a little bit here and had a nice rally of $10, but this blue line's already rolling back down again. So I'd be careful as sketchers. And again, the idea that inflation will abate, part of inflation is apparel. So see what happens. PYPL. This is a payment deal, and the payments are supposed to be a good deal going into next year, and they've been discounted. So here, this is the place where you're supposed to be taking a bite of PayPal right around 180. And if you go to the 5-year graph, you'll see again, this 180 area, is holding up so far. RSI right now is at 40. So, again, if it were to get under 40, we talked about accelerating to the downside. So if this thing breaks 80 and you see an RSI breaking under 40, this thing's probably going to go into the abyss. It already has gone into the abyss, down $120 off its high. But right now it's set up for what they call a snapback rally in Q1. And so basically, we have to look at the shorter term graph to get some kind of a line in the sand to see if it's turning. Yeah, it is trying to turn. Right now, you got a lot of action around 188. So you want to keep this baby of 188, and getting above 195 would be very welcome. You've got a gap at 220, and your RSI on the 1 year is coming in at 30. Ooh, is it 39 still? $39. So again, it could be the start of something. Certainly, you have a higher low there. That's a good sign. You went up, you came down, you didn't take out the low. That's a good sign. You're getting above these averages. That's a good sign. Okay. Getting above this number here would be a very good sign. And that number there, the high was 197. So getting above 200 is really a key for this thing, because it is the kind of stock that can fly a little bit if it gets going. So is this something I would be looking at? Yeah. If you sell puts, it could be very dangerous because if it breaks under 180 and the RSI starts tanking, there could be trouble in PayPalville. But the payment group, such as the ETF iPay or Visa, MasterCard, or other forms of payment, there is a situation where, there could be an opportunity there. So I'm not poo-pooing it. I'm just saying it's a little early. And if it gets to 200 and it's on its way to 230 or 240, it might be a much more comfortable ride than buying it down at 180 and 190 and having a prayer as your reason for doing it. Because right now the technical situation is a downtrend. Again, it is oversold. I mean, that's oversold. So, I mean, I know why you're sniffing around it. And this is the kind of thing that could snap back big time if there's a stampede into stocks and business going into next year. So I'm just saying, you got a good line in the sand. I certainly want this thing under 180. And this might be something to use options on, because obviously the calls should be somewhat reasonable down here. So calls and call spreads might be considered. And then if it does tank down here, at least you got limited risk. But I'd give myself some time. So I'd buy longer term dated stuff. And if I had to spread them, I'd do it. In other words, you'd have to spread them, buy the call and sell the out of the money call to make the premium reasonable. So that's the way I would see this right now on PayPal. Okay, next one is HIMX. All right, HIMX, again, for those of the uninitiated, is semiconductor solution provider. Semiconductor solution provider focused on display imaging, processing technologies. They're located in Taiwan, so you got to keep an eye on those Chinese boats out there in the harbor. And basically, it's getting a bid now, so it is turning. Let's go back how far it goes back. Yeah, I mean, this is a good company, but volatile. Went up through the roof, came back down, didn't break that. So buying it against there, getting back above the red line's a good one, and the red line comes in at 1250. So you certainly would like to see it stay above there, and there's your 10 area. So that's pretty obvious. RSI is still in the 59 area. So again, if we can get through the 60 number, there could be another rush to hit that high. Now let's look at the 5-year. Yeah, well, like I say, this is a market that was coming down like some of the ones we've seen. And you can see that once it gets above the first average, which is the 12 SMA, that's your first buy signal. And your RSI is right now is going for 58. So it's on the verge of being something pretty exciting. Okay. And on the 1 year, again, the buy signal here came in at around 1050. So the bottom line is this thing you should have been long already. Now it's way up here. So you can see it's overdone on the short-term basis. Your RSI is up at 65. What we say, if you follow your RSIs, and once it gets above 60, which is at 57 here, and then it goes to 57, and then it goes up to 59. So it breaks out at around 11. And so it just gave you a $3 run. That's called acceleration. And that's when it goes through 60. Anyway, looks pretty good. It's extended, what to do with it. Obviously if you own it, if you wanted to protect yourself with some puts with some of the profit you had, that's one thing to do. A married put, you got to price them out, or a put spread. And then of course, if you want to replace your trade, what does that mean? That means I bought it at 10. It's up here at 15 almost. I take $4 out of it and I put a call option at 15 or 16 for a fraction of the $4. I pocket the rest of the money. If it pulls back, I'll buy back into the stock. If it keeps going, I'm protected because I got a call at 15 or 16, and that's my protection and hedge against higher prices. So you can use options to obviously adjust the risk profile by doing what we call replacement trades. And that's an example of a replacement trade. Okay, next one is AZO. This is Autozone. Pretty expensive stock, as I recall. Yeah, so I don't know how many shares you're buying at $2,000 a throw, but obviously it looks good. But again, this is another one you might say to yourself, is this a deal that will be affected if used car prices start dropping and there's a shift to new? If there's a shift to new and people don't have as many used cars, then obviously this may affect this company, because this company's gone nuts, because obviously this is a product of used cars going through the roof. And after you buy used cars, what do you got to do? You got to go down to AutoZone and buy parts for the darn thing, right? So that's why you're here. So what would change here is people buy a lot less used cars and they start leasing these cars for fractions on the dollar, because for $500 you can get a brand new car, and $400 you can get a brand new car, and you don't have to worry about AutoZone because you got a warranty on it. So that's the thing down the road that let me see here. Yeah, that's the one. Now let's look at the shorter term graphs. Okay, on the shorter term graphs, you are at a little bit of extended, right? 1900, they come in and all that. So it's extended. RSI is up at 70. This thing looks like it's had its move. So, I mean, it's up 12 today, God bless it. And it's probably making all-time highs, but I'd monitor it. And again, I certainly wouldn't initiate a position up here when the RSI is up at these kind of levels. Again, you can play it for the upside here. If you were a short-term trader, I would definitely keep it on a leash that had a number 2014 on it. And even I would go to the monthly graph and I would put a leash on it somewhere even at where the red line is here of 2036. And then if it's going to fly, God bless it. And if it's not, you got it on a shorter leash, because again, this is a very expensive stock. A 5% drop in this thing or a 10% drop, you're talking about real money. Okay, we got Moneygram Mgi. And again, this is a payment deal, so this could have some potential. The problem with this company, it has, by the way, AutoZone has a 20 PE, and that Himx has a 7.4 PE. But again, it's a Taiwan company, so that's another risk. Okay, Moneygram, again, they're losing money. Let's see what it looks like here. If there's any reason why this thing might be a good deal. I mean, look at this thing. It looks like it was a nightmare. Let's go to the 5-year graph where it maybe looks like something might be better. Okay, so again, it's still underneath the moving average here, which is around 844, but it is starting to look like it's making a turn. But don't forget, this could be a bounce up and then a tank job. Where's your RSI right now? On the 5-year, it's at 50. So it's very key. It's right on the ledge. It could be turning into something. I would like to see it above $8.50, frankly. And then basically here again, now you've got a better looking graph. The blue line's moving up, but the blue line's way down here at 670. So, and again, it has not been able to get above the red line, which comes in right there at 771. So lines in the sand here for me would be 850 would be something that it looks like it's breaking out. And then basically getting above even the 771 would be a positive. And then on a pullback, $7 and 670 looks like two things. This is a transfer of money type thing. So obviously that's always going on. Okay, I got to hustle up here a little bit because we're getting up to the top of the hour. Let's hit Nvidia. Nvidia again went down and now it's getting back above its averages again. So you'd love Nvidia to stay above certainly 280. And on a 5-year graph, you can see right against the red line, that's your buy right there. So again, that was your buy. Now you actually should be in. And then of course your get out, if you got in here, your get out point is you can move your stop up to 280 and you got a break even stop or better. 20-year graph, obviously it's in orbit. This is one of the ones that people go to thinking they're buying, no risk, Microsoft, Apple, Amazon, Google, Nvidia, bulletproof. And that's these are some of the companies that people think people park in the first half of the year as they sit back and go, what's the tightening going to look like? What's the GDP looking like? What about this variant? As these inflation numbers going to continue to go nuts, while they're viewing all that stuff, they like to view it with the biggest companies in the world that have pricing power and have lots of money to buy their own stock back and all those kind of things. Okay, Nvidia is one of them. If you want to keep it on the shortest leash possible, Again, the shortest leash possible would obviously be where it is now, which is 303. And then basically underneath there, shorter leashes would be in the 295, 290 area. Okay. All right. There were a couple of companies that had unusual option activity. I'm going to jump over to those now. And then I'm also going to explain how you can keep in touch with us and find out what we're doing and learn how we're doing it. And also ask your questions. I mean, I invite people to ask questions. I don't know why they don't do it. Anyway, Disney. A lot of people are jumping in now. This is obviously a try to buy the low. So, you know, you're trying to buy something because of its value, not the trend. Believe me, not the trend. But we're looking down the field. We get through the winter. What's going to go on in the spring? If there's no variant or there's pills to take care of it, people are going to want to get out. Where are they going to want to go? They're going to want to go on leisure and travel. Leisure and travel is Disney's game, right? So the bottom line is it's at a very low price. It really hit a great price right there. That's where I was suggesting people get it right there. 145, 143, that's where you should have been buying, and buying it now ain't the worst idea in the world either. And your RSI is still above 50 on the 20-year graph. So this is where you take your shot. And then if you go to the 5-year graph, you know, it's going to look lousy. Why? Because it's been coming down from 205 down to 140. So the bottom line is that it's going to look bad on everything else. And it may tank if the whole world doesn't go out and start doing things. So again, Disney looks like it's going really 150. You want it to stay above 150 right now. No doubt about it. And it did break above this point, which is not bad. So if it pulls back, let's hold 150. And then maybe it'll go into this gap at least. But maybe on a longer term basis, it's going to be a great thing to own as we go into next summer. Macy's, number 2, had another unusual, lot of option activity. And here you go on it. You're looking at on a 1-year basis, it's starting to make a turn, but let's look at it on a long-term basis. Maybe that'll help. On a 5-year, let's see. Yeah, you see, it came down here to your line. So you should have been buying it against the line, which is around 22 bucks. It's already at 26. So I would ride this thing as long as it's above 22 bucks. And if it gets above 28 bucks, it could be off to the races. So there is something going on here that might be interesting. Okay, we are coming to the top of the hour, and I have covered a lot of information for you and a lot of different option ideas. Optionprofessor.com. You can go to the website and you can put your email in. And then you can also go to optionprofessor@gmail.com. And if you have any option questions, you know, how do I create income with options? You know, what do I do if I do a covered write and it goes against me? What about credit spreads? Do they make any sense at all? I'm in some credit spreads. How would you handle them in your opinion and in your observation? You know, I'd be more than happy to help you with those kind of questions. It's Option Professor, OPTION, Professor, PROFESSOR @gmail.com or .com. And then when we have subsequent meetings on options and get into more specifics, you can be notified for that as well. The final thing is we have a collective 2 account for Option Professor, and its cumulative return is up 75% in the last year and a half, which is a compounding annual return of 53%. And you can learn about how to get access to that collective 2 account, and also how to get ongoing updates through the emails we send out from the collective 2 account on things that we're doing, positions we're putting into the collective 2 account, so you can monitor it throughout 2022 and also have access to us for questions and answers. Again, we've been doing this for decades. We have been in the industry for decades. We are very knowledgeable in this area. We're very humble. We don't know exactly what's going on all the time, but we do our best, as you can tell. You know, a lot of people are touted as these smart guys, you know, because they said 4,800 on the S&P, but some of these guys also said 100,000 on the Bitcoin, and that didn't happen. So even the most popular callers clearly are not right all the time, and sometimes are very wrong. A lot of people thought the Russell was supposed to go through the roof. That never did. We stick with the graphs, we stick with the technicals, and of course we read the news. So we bring a lot to the table here. So go to optionprofessor.com so you can get involved with our meetings in the future and learn about the Collective 2 account and how you can get access to that, which has trades in there. And then also send emails over to optionprofessor@gmail.com with your contact information, and I'll try to help you with my opinion and my observation with anything you bring to us. Okay, great to talk to you here. I hope you learned something today. There's so much more to learn, so keep in touch, and then have a great happy new year. We'll be back with you after the 1st. Right now, I'm going to send it back over to David Kosmeter, who has done a great job this year and every year bringing timely information to you guys on a weekly basis. Have a great new year, guys. And David, back to you.
All right, thanks to the option professor for his market analysis today, and for being a great presenter and moderator for all of these events every week. So thanks to him. And so just a reminder, this is our last show of the year, last event, but we have a ton of good stuff planned for next year. So be sure to watch your email and watch the Timing Research site for info about that. And just a reminder, you can also subscribe to Timing Research on YouTube and your favorite podcast app to get instant updates when I post new events and videos and presentations. Also, you can just go to TimingResearch.com to get access to this episode as soon as I can get posted, as well as any of the past shows and events. So thanks, everyone.